All right, we're looking at scientific research and experimental development, which normally goes by the name Sr&Ed. A lot of people say Sr&Ed. If you want to feel really cool and fit in at cocktail parties, you can say Sr&Ed too. So, but Sr and Ed, we are going to just scratch the surface. And really we look at this just so we can get some idea of how the government uses credits to encourage and support various things that it likes to encourage and support. And so we're going to look at this one, the experimental research and development, as the test case. But you will go much deeper into this in your next tax course. And so we're going to we arrive on the scene when most of the work has been done. So let's just take I thought the best way to look at this is to remind ourselves that, when a normal dollar, so when $1 is spent, come on, eraser, when a normal dollar is spent, well, this is all we've been doing in this course, right? We have a whole bunch of decisions to be made. So we decide, is this thing capital in nature or is it income? And if it's income, is it deductible for tax? And if it is, then when? And if you are able to deduct and there's not enough income, then you generate these losses, and then we have all these rules for carry forward and carry back. Okay, so we have this general idea of when we spend $1, if it is deductible, it will reduce taxable income once at some point in the life of this company. Well, an Sr&Ed dollar, when it gets spent, things are different. So first of all, I want to note again that all of the work is in determining qualification. So in the real world, hours and hours and dollars and fights with CRA are about whether or not this dollar qualifies. So whether does the project qualify, and then does this dollar qualify? So that is where all the work is done in the real world, and we're arriving on the scene when that determination has been made. The other important thing to note here is that more things are included than when we look at normal dollars. So more things are included. So for example, we have a lot of capital assets that would, if they were normal dollars, would be put into CCA pools and all of that. They just are 100% deductible if they are Sr&Ed dollars. Okay, so that's really important to note. But now that we have this and we know that this dollar qualifies, then instead of having to go down this path, or these when does it all happen, it is deductible. So no question mark. And when is it deductible? Well, when you choose. So the taxpayer chooses when it gets deducted. And so obviously the default is right away, because we can reduce taxable income. So we want that as early as possible. But there may be times when you want to time it, and so you choose when to deduct it. It just goes into this pool. And then most importantly, it also generates a credit. So we'll call it creditable. But this is so important to note that this $1 does two things. And so I want to make clear, really, this video is, the main goal of the video is to help you understand what the difference is with this $1, how it does two different things. So the best way to think about an Sr&Ed pool, which is the terminology we use, an Sr&Ed pool of deductions. Well, it functions exactly the same way as, so think CCA class. Okay, so we know that a CCA class is basically everybody's favorite analogy, a bucket. right? So what increases this? Well, when you spend money, your pool of deductions that you can choose when to take them out, choose when to use them to reduce taxable income, it goes up. So you spend a qualified dollar, you have a new dollar in your bucket. What does it go down for? Well, when you take deductions. So when deductions are used to, and let's just be clear, to reduce taxable income. So when you decide that it's time for us to use this deduction and reduce taxable income, then obviously you can only use these things once, and so they leave the pool. But this pool is also reduced by credits that are claimed, and we'll talk about where these credits come from next. But when you claim a credit, then basically what you're doing is you're saying, okay, I've taken advantage of a dollar that the government had there and had their arm extended with this dollar at the end of it. I've now taken that dollar. And therefore, really, when you think about these things together, it makes perfect sense that this reduces the pool, because really the government has covered some of the expenditure. So it's really reducing what it cost you out of pocket to pay for whatever it is that you paid for that went into this pool. Okay, and then also, just like a CCA class, important to note, if this goes negative, and so when would this go negative? Well, it's not too hard to see. It could only go negative when credits claimed are greater than deductions available. So if you get more, and this can happen because of the mismatch in rates, if you claim more in credits than you have available in deductions, then, well, what's going to happen? Just like a CCA class, similar to recapture, then the credit that you claim will just be treated as income. Okay, but this is not punitive. You don't need to think, okay, well, that seems ridiculous. The government is giving these people a credit and is taxing it. Well, believe me, you'd rather have the government give you a dollar and tax it than not give you a dollar at all, right? Because you're left with the after-tax amount. So this is exactly how this works. So where do the credits come from? Where do these credits that you can claim come from? Well, basically, all the credit is, so what is a credit? A credit is basically money given by the government. So the government says, you want to spend something? Well, you know what? We'd like to help you. We would like to help you buy that thing. But they don't hand you the money. Instead, they do this through a reduction of tax payable. So this is not money that the government hands to you, but they basically let you pay your taxes and then hand it right back to you. And so, that's the substance of the transaction. So I think what might just be helpful, this is really a general reminder, but let's just remind ourselves, what are the differences between deductions and credits? Because this has been true before, but it's absolutely true in this with Sr&Ed. So what do deductions reduce? They reduce taxable income. What do credits reduce? They reduce tax payable. So basically, it's the government saying you owed us a certain amount of money, but you now owe us less because of this credit. And then what are your tax savings? Like, how much do you save for a dollar? Tax savings. How much do you save for a dollar of deduction? Well, you save at your marginal tax rate, whereas a credit you save at a specified, so whatever the rate is that the government has said, we're going to give you X% of every dollar that you spend in credit, then you're saving at a specified percent. So it makes perfect sense then, I hope, looking back up at this bucket, that as the government contributes through its credits, it's going to reduce the amount that you have available to deduct. But you can see that it's very different from the normal dollar that we're used to seeing, which just is a deduction, and it ends up hitting taxable income once. Well, so do these. They end up hitting taxable income once, except now they generate this credit that has to be flowed through the taxable income at the same time. Now, the credit either reduces the deduction available, or if there's no deduction available for it to reduce, it will be counted as income. And that's it for Sr&Ed for us to understand. So when we do these two problems in class, I think it'll be pretty clear the extent to which we want to know this stuff.